managed to beat those optimistic estimates as well. What's the status on ground demand, if you could tell us, as auto as well as auto components, consumer durables, all that demand is now beginning to pick up and kick back?
Yeah, I think the kind of recovery which we have seen in the Q2 is quite encouraging. Industry as a whole, if I look at it from 1st of April to 30th September, the total amount of inventory that has been liquidated is 1.8 million ton. It is quite substantial. Even JSW Steel, if I look at it, we have reduced our inventory by 4,75,000 tons. So there is liquidation of inventory. This has been caused by good traction from various user industries. Nobody anticipated that the auto industry will come back so robustly. We have seen quarter on quarter, there is 392% growth in the volumes to the auto sector. Even year on year, there is a significant growth in the auto sector. This is the quarter where we have made highest ever sales of coated products. We also have made a very big improvement in the sales to appliances sector, solar, and also government aided projects. So therefore, the demand is really picked up. But what is very relevant here is, if I look at quarter one, the fall in demand was more than 50% year on year. Same number, if I have to look at in the quarter two, the fall in demand year on year basis was only 10%. So therefore, the improvement month on month or quarter on quarter is very, very encouraging. We expect that the momentum will continue to be there in the Q3 and Q4 also going forward, particularly from the rural sector and also from government aided projects. Plus whatever recovery we are seeing in other segments, they will continue to be there.
Mr. Rao, we've been talking about how metals have clearly been the hot favorite in the markets, and why not? HRC prices are already beyond, 43,000 as we understand, the highest level since December 2018. While demand in India has been good, you think there's also the China factor which is at play here?
Because you are comparing the steel prices relative to what it was in the Q1. You compare with the lowest level and then see the steel prices, you feel that it has gone up. But if you look at even Q2, year on year, if I compare, the steel prices in the Q2 2021 is lower by 2%. Whereas quarter on quarter, it went up by 11%. Whereas if you compare the global prices, the way it picked up from 1st April 2020 to 30th September 2020, international prices of steel went up by 27%, and in this quarter, they went up by 16%. So if you compare with the type of increases which have happened globally, vis-a-vis the domestic prices, still domestic prices are at a discount. So you have to look at in the context then saying that whether HR coil prices are at what level.
Good morning, Mr. Rao. Nikunj Dalmia also joining in. Now, while China has opened up a never-ending flow of stimulus into economy, will the price pause? Do you think price has or do you think the steel pricing in China have already peaked out in this cycle?
I think we have to see what is happening globally. When we say there is a rebound in the economic activity, it is quite uneven. If I look at China is concerned, they have produced more steel than what they have produced in the previous year in the corresponding period. They also exported less. Their exports have fallen by 20%. If I look at their imports have grown 3 times. So imports are higher, production is more, and their exports have fallen. So what does it mean? That means very strong domestic consumption within China because of $550 billion stimulus which they have given it to the economy. Out of $550 billion, more than 50% of that stimulus is for steel consuming user sectors. That's also one of the reasons why the domestic steel demand in China is so strong. But if you look at China aside and see the rest of the world, there is a fall in supply. So that the overall production has come down quite significantly. It is almost over 70 million tons of lower production across the world other than China. So one side China is increasing the production, rest of the world is adjusting the supply in line with the very slow recovery in the demand. Therefore, the supply adjustment plus very strong recovery in China, both together, is helping the steel prices to be at a healthy levels today. I don't think the situation will change very quickly.
Mr. Rao, NMDC has also increased the iron ore prices. Could that be a dampener on your margins?
There will always be cost pressure as and when iron ore prices are going up either in India or globally. So today we have seen the iron ore prices going up and correcting to $120 per ton globally. So the NMDC has gone back as far as the price is concerned to the levels that we have seen before March. It was 2,960 rupees per ton. Today's prices are 2,960 rupees. So whatever reduction they have done to the extent of 1,000 rupees per ton in the 3 months following February, all have been reversed today. So it is at 2,960 rupees per ton, plus royalties, plus the cost of transportation. So the increase in iron ore prices that has happened in the past few months, that impact will definitely be coming in the cost of production for this quarter, that is Q3. And at the same time, the coking coal prices, where they have fallen in the previous months, they also shot up. But one measure which Chinese government has taken of restricting import of coking coal from Australia, so that again brought a very sharp fall in coking coal prices in the last few days. So again, it is at a level of $114 per ton. So there is some volatility in the coking coal prices which we are observing. But if I see our total cost of production structure, even in the last quarter, we reduced our cost of production. Quarter on quarter, if you see, it is 11%. If I see year-on-year basis also, we have reduced our cost of production by 5%. Sorry, quarter on quarter by 5%, year-on-year by 11%. That is how we have contained our cost. All this cost reduction not necessarily only from iron ore and coal. So there are a lot of other areas where we are focusing to reduce our cost. That is the reason why our margins have improved. When our margins have improved on quarter basis by 5,000 rupees per ton, the entire 5,000 is not contributed by improvement in the sales realization alone or product mix. And also there is a significant portion that is contributed other than iron ore and coal from other areas of measures the management has taken. Therefore, we continue to do that even in this quarter, notwithstanding some cost pressure from increased iron ore prices and also some volatility in the coking coal side.
Right. You have about 27% of your iron ore coming in from captive mines. As Karnataka's two mines now coming to the picture and more from Odisha as well later, will this really help reduce your cost of production?
We are ramping up our mining operations. We are increasing the production. In Orissa, whatever mines we have got, the 4 mines have become operational. We are ramping up the production. Many of the steel companies in India today are suffering for lack of iron ore. Iron ore exports have gone up quite substantially in the 6 months. It is more than doubled, in fact, in the 6 months. Not only iron ore exports, even pellet exports have gone up by 57%. So that is causing a huge amount of shortage. One side production is lower, there are logistics constraints, and exports are happening. All this together is impacting the steel companies to increase the production levels in India to meet even domestic demand. So therefore, this continues to be a problem. So as far as JSW is concerned, the 9 mines which we have got in Karnataka and the 4 mines in Orissa, our effort is to make these mining operations more and more efficient, more cost effective, and we'll be able to meet our entire requirements of Dolvi and Salem from Orissa mines, and as much as possible to meet our requirements in Vijayanagar from captive mines and improve our capacity utilization.
Sure. How do you see your own profitability and EBITDA per ton trend?
EBITDA per ton we don't guide. It depends on several other factors. We guide on volume of production and volume of sales. Volume of sales we have guided 15 million ton in this year. So we are very confident that we'll be able to achieve that.
Okay, now you have a fair amount of mine commissioning expenses lined up, growth capex, a probable acquisition of Bhushan Power, Vardhaman, Asian Color. On the cash front, just throw some color on exactly where you stand, and on the debt by the end of the fiscal as well. Any loan repayment, given the fall in interest cost that you're factoring in as well?
Even in this quarter which we just ended, we have released working capital by reducing our inventories. Our inventories were reduced by 4,75,000 tons. We have used that money to reduce the debt. Our debt has been reduced by 1635 crores in the last quarter. All our ratios have improved. Either you take debt to net worth or debt to EBITDA, there is an improvement over Q1. So we continue to make efforts to bring our ratios, relative ratios, to the level of guidance which we have been telling the market. So we were very comfortable at 3.75:1 debt to EBITDA. Even now, after reduction of 1635 crores, we're at a level of 4.73. So we are making efforts to bring it down. We don't focus on absolute number, we focus on relative number. So either by improving EBITDA or by reducing the overall debt, we wanted to make it at 3.75:1. We are moving in that direction.
Okay, Mr. Rao, just one final question. Many of your overseas subsidiaries are reporting an EBITDA loss. We've seen the standalone business as well financing some of the units as of now. What's the plan for these businesses that you've chalked out?
You must have seen the numbers quarter on quarter basis. If I see from overseas, the losses are gradually coming down. Even in the Q2, if I take out one-off items, both from Italy and also from US, the operating EBITDA loss was 213 crores, 213. Then there is one-off items which has given a gain of 161 crores. So net overseas have contributed 52 crores negative EBITDA, operating EBITDA in the consolidation. But consolidated EBITDA is higher by 238 crores. That means our Indian operations have done very well, particularly the coated products. They have shown an EBITDA of 288 crores. So there is a big improvement in the Indian subsidiaries, and the losses in the overseas are coming down. As we have guided, our effort is to make our overseas operations EBITDA positive by end of this financial year or early next year. That is how we have been
Mr. Rao,
working.
really appreciate your time. Thank you for joining us. I'm just going to mark some stocks here.